Hey everybody, it is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, February 22nd, 2025. Hey, how you doing? I hope you're having a good weekend. I appreciate you being here and watching my weekend review podcast. I am back in the United States, and boy, I'll tell you, what a big difference. One day I'm on the beach playing baseball, the next day I'm at home shoveling 3.5 feet of snow. Wow. It almost seemed like a dream, but glad to be home. Just trying to settle back in after 3 months out of the country, and this is the first podcast I've done from the States, so hopefully it will be a good one. So we had a big down day on Friday, quite interesting, and I'll get into that in the podcast, and we'll kind of see what it means and maybe where we're going from here. But the format for the podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades and positions that I have and made last week. I'm going to talk about when I entered the trade, why I entered the trade, what the setup was, what the confluences were, how I'm going to position size correctly, how I'm going to place my emergency stop, my end of bar stop, how I'm going to take partial profits if the trade goes my way. If it gets to a certain level, how I go into trailing stop mode, and then how I am going to manage the trade and ultimately get out of the trade from there. So I hope that's going to be helpful for you to get an idea of how I look at markets, how I'm patient, how I wait for proper setups before I enter, and then how I manage them. So I actually had a really good week last week. All the trades went in my favor, so I'm grateful for that. And like I said, I hope it's going to be helpful. And if it is, I appreciate if you can hit the thumbs up, maybe subscribe to the channel. That'd be wonderful. And that lets YouTube know that there's some valuable content and gets it out to more people. So after we take a look at all the trades and what I'm doing with them, I'm going to talk a little bit about trader psychology. Always the most important skill in trading, and really the most important topic, is the ability of trader psychology. And really what it comes down to is the ability to create a trade plan, but more importantly, follow it. There are so many different ways to trade, and as long as you're using good trading principles of position sizing correctly and getting out quickly when you're wrong and staying in when you're right, you're going to do fine. Whether you learn it from me or learn someone else, it's fine. But the key point is that you need to follow those rules. It's the most important part of trading, is following the rules. And it sounds easy before you get into it, but once you're into it, then your brain switches to another mode, like, oh, that's a big loss, I should just probably get out. Well, if it's not where you're supposed to get out, you should probably stay in. Or if it starts moving up nicely, you're like, I could take that right now and buy a jet ski or something, right? But if the price action doesn't tell you to get out, then you should just probably stay in. You should probably follow your rules. So hopefully the trader psychology portion is going to be a benefit for you. And then after that, last night I did go down through my master watch list, both on the daily timeframes and the weekly timeframes, and I have identified some potential trades for next week that I'm interested in potentially entering. Now, they're not at the levels they need to be, but if they get there and have the right price action at those levels, then I will potentially take an entry. As small retail traders, one of the greatest advantages that we have is we can just sit and wait for the price to come in exactly where we want it to. Now, doesn't mean that if it gets exactly where we want it to, it's going to be a profitable trade, but it helps. I'm telling you, it helps. And, if 60% of the time it works and 40% of the time it doesn't work, well, then you have an edge, and that's what trading is all about. So, like I said, I've gone down through my master watch list, both on the daily timeframes and the weekly timeframes, and I have identified some potential trades next week if and only if they get to that particular level, which means they either have to go down more or they have to go up more before I'll get interested in. So I hope you're going to find that helpful. If you have any questions of anything that I discussed today in the podcast, please put them in the comment section. Do my best to get back to you. And yeah, that's going to be the format for today. So let's get this U.S. legal disclaimer out of the way, and then we'll come back and we'll get started. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. Thanks for holding on through me with that, and let's get started. So the first position that I'm in on the daily is NVIDIA. And so I'll walk you through a little bit more in detail this trade than the rest of the trades, just so you can see exactly what I'm doing, how I set it up. But I did get long NVIDIA. Really, I caught the bottom back here on the 3rd of February using the strategy for this particular trade was a deep dip buy strategy, which is something I've used for years and I also teach. But the deep dip buy incorporates either the 200-day moving average, which is the black line, the purple line, which is at 250, or the 300, which you can see down here, and or a 30 RSI. So in this particular trade, I did key it off of the 250 because there was an intraday rejection of the 250. Now, I always make my buying and selling decisions based upon the closing price of the day, unless it's my emergency stop. So let's see what happened on this particular day. On the day that I entered, you can see the price went below the 250 during the day, but recovered and closed back above the 250. That is a deep dip buy. Now, I always like to look for confluences, meaning that it's more than just one signal, and the secondary confluence signal was also the rejection of the negative third ATR channel. You can see the negative third ATR channel here. 92% of prices, when they get to the negative third ATR channel, tend to stop going down or go sideways or go up. So that was the confluence. It's very important in your trading to look for confluences. So the confluence of the trade was the intraday rejection of the 250 and also the intraday rejection of the negative third ATR channel. So as soon as I find my signal, the most important part of trading is that you position size correctly. So I'm going to show you how I do that. So I have a formula. So once I see this trade and I'm like, okay, this is a legitimate trade, I am going to do the following to come up with how many shares I'm going to use. So the first is how much is in your trading account. All right, let's just use $200,000 today. I take 1% of my trading account. 1% of $200,000 is $2,000. 1% of $100,000 is $1,000, right? And so on. Million, it's 10,000. So if I have a $200,000 trading account and I times it by 1%, my maximum allowed loss on this particular trade is $2,000. So I take my account value, times it by 1%, come up with that number. Then I look over here at the average true range. The average true range times 2. So the 2 average true range, that number right now is 13, what is that? Oh, 98, okay. So 1398. And the reason that I use this is because this is 2 times the average true range. This is what helps you account for the particular volatility in the market. If this number is higher, you're going to buy fewer shares. If it's lower, you're going to buy more shares. So 1% of your capital divided by the 2 ATR, that's how I come up with how many shares I'm going to buy. So we take $2,000 divided by 1398. That tells me to buy 143 shares. So, and remember, my maximum allowed loss is $2,000. So what I do is I have the entry. I did the math on how many shares I could buy. I buy 143 shares right there. Now, the next thing I do is, remember the 2 ATR, 1398, I take my entry price minus 13.98, I put a line. This is my emergency stop. So if I buy 143 shares and it goes down 13.98 to this line, how much is that? It's $2,000. That's the maximum I'm going to lose on any one trade. And again, my entries and exit are based upon the closing price, but with an emergency stop, which this is the emergency stop, 2 ATRs below, if it gets there, whenever that hits during the day, I'm out. I don't wait for the close of the market, because if it does get down there, I lose 1% of my account or $2,000. But the good news is that I only hit my emergency stop about 5% of the time. The other 95% of the time, if I have a loss, it's going to be smaller because it's going to be my end of bar stop. And my end of bar stop is generally just the opposite of why I took the trade. So the 250-day moving average here, the deep dip buy, if the next day it had closed even just 1 penny below, I'd simply be out, because now I have that resistance of the 250 above me instead of below me as support. Makes sense? So that's what I'm talking about, risk to reward. This is a good risk to reward trade. If the next day it just closes here, boom, I'm just out. The next day I could get in again if it closed back above, but if it has a big drop down, then I'm out, and I can look for lower signals to get into the market. All right, so what have we done so far? We saw the entry, which was the intraday rejection of the 250 and the intraday rejection of the negative third ATR channel. I position size correctly. I placed my emergency stop. I know where my end of bar stop is, just to close below the 250-day moving average. Now, the next thing I do is I take my entry price and I look and see what the average, average true range, the 1.5 average true range. It's $10.49. So I take my entry price, I draw a line $10.49 above me. So if the price gets up to there, now I change my rules, I change tactics. Now I'm going to be tightening up my stop because it's moved enough. And so if I get to trailing stop level, it doesn't mean that I do anything. It just means that in the future now, if I have a close below a previous bar's low, I'm going to exit half the position. So, you know, you hear about if the trade starts going your way to tighten up your stop. Well, this is exactly what it's doing, because if it gets to 1.5 ATR, now, if I have a close below a previous bar's low, I'm tightening things up, right? I still have half, but I'm getting rid of half. So far, everything I've talked about, the position sizing, the end of, or the emergency stop, the end of bar stop, the trailing stop level 1.5 ATRs above my entry, these are all defensive moves. Or in other words, if something happens and goes against me, then I'm going to take action. All defensive. But I like to play offense in my trading as well, just like any sports team. You need to play offense and defense. Well, trading is a sport. So I've discussed my defensive moves, but the offensive moves are that I take a portion of my position off on the way up if it moves a certain amount from the previous day's close. So let me show you exactly what I'm going to do for Monday, and hopefully this will illustrate it well. So at the end of the day, I always look at the closing price. The closing price is 134.40. 134.40. And now I look over to my 0.45 ATR. See right here, 0.45 is 315. So I take the closing price of the day, 134.40. I add the value of the 0.45, which is 315. Now my first profit target on Monday is 137.55. That's my first profit target, but I always place 3. So my first profit target's 137.55. I again add the 315 to it, plus 315. My second profit target for Monday is 140.70, and then I do it one more time. I take 140.70, which is my second profit target, add the 315 to it again, and that's my third profit target. Every day going into the market, I have 3 profit targets set using the methodology that I just showed you right here. And the question is, how much do I sell at that profit target? 10% of however many shares I have left going into that day. So if I had 100 shares left going into Monday, I would sell 10% of that. If I had 100 shares, right, I'd sell 10% at the first profit target, 10% at the second profit target, 10% at the third profit target. Now, if the market's down, well, you're not going to hit any profit targets, right? And I just have to redo it again the next day. And, if the market's up decently, I may hit one profit target. I take one profit target off. If it's up really good, I might hit two. If it's really great, I might hit three. So I'm taking advantage of taking the profits while the market's giving them to me, but not all, just partial. There's so many advantages to doing this, but really, again, back to the sports analogy, trading's the sport. In my opinion, you need to play both offense and defense. All right, so that's the offensive part. All right, so let's again put it all together. And again, I'm spending a lot of time on this chart, but going forward, I won't spend as much time. So again, we have a deep dip buy on NVIDIA. I entered at 117.10 because we had intraday rejection of the 250. We also had an intraday rejection of the negative third ATR channel. Got long 117.10, position size correctly, placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 250. Once I entered, I put my trailing stop level 1.5 ATRs above, and off we go. The next day, it does move up enough for me to hit one profit target. Next day, moves up enough for me to hit two profit targets. So I'm scaling out, I'm taking profits as it's giving me. Next day up, one more profit target. Next day here, it goes up a little, but not enough for me to hit a profit target. But the important thing that happened on this day is that we get to trailing stop level. So I don't do anything. It's just that I'm in trailing stop mode, meaning that in the future, if I have a close below a previous bar's low, I'm going to get out of half. Next day, up again, really nicely. Hit a couple profit targets. Then we have a couple days down move. This bar here almost closed below the previous bar's low, but it did not, so I did not take profit target, or I did not sell half the position because I'm in trailing stop mode. Next bar up again, more profits. Next bar up again, took another profit target. Next bar up here, again, I took 10% of whatever shares I had going into the day. Then we had a couple days sideways motion with no profit targets or anything, and then Friday we had the big down bar. Did this close below this low? It did. So this was the first close below a previous bar's low after reaching trailing stop level. What did I do on Friday? I took off half of the remaining shares that I had. If I had 80 shares remaining, I sold 40. And selling half is one of the only win-win situations in trading. If I sell half here and it goes down again on Monday, I'm glad I sold half. If Monday it rallies, I'm glad I still have half. You see what I mean? So I'm a big fan of taking half. So the remaining shares that I have on NVIDIA up 12.48%, and it's a good example of a deep dip buy with a very good risk to reward ratio that worked very well. So the remaining shares up 12.48%. By the way, earnings, it looks like, are coming out on the 26th. I never hold through earnings on my swing trades. And so regardless, as long as I'm still in the trade, whether it's up or down and still hasn't hit my stop or hasn't given me a reason to get out of the upside, I will exit wherever it is before earnings because I don't hold through earnings. It's a really good way to make a lot of money fast, but it's also a good way to lose a lot of money fast. And our job as traders ultimately is to preserve our capital. It's not to make money. But ironically, if you preserve capital, if you're on the defensive about your capital, that's how you make money. If you really try to make money, that's unfortunately usually how you lose money. So deep dip buy on NVIDIA. I took off half on Friday, remaining shares up 12.48%. Okay, let's go to VIX. Okay, VIX. I want you to take a look at this green box here. This is not a deep dip buy. This is what is called a bullish order block. And this bullish order block goes, I know you can't really see the screen, but it formed all the way back here on the 12th of January. An order block is your lowest bar close before you change market structure to the upside. And why that's important for me, that if it does now come back into the order block, the markets usually have a memory there and tend to bounce at those levels. And you can see that is true. When we finally came down to the green here, what do? We rallied. When we finally came down to the green box, the order block again, we rallied. And I took the trade on Thursday. Why? Well, because we came into the order block and we also had a V1 signal. That was the confluence of signals. A V1 consists of 2 bars. A V2 consists of 3 bars. This V1, you can see we have bar 1, bar 2. Bar 2 goes under bar 1's low and then closes above bar 1's close. That is a V1. If you'd like to learn more about V1s or V2s, just go to my YouTube channel. I have a whole video about that there where I get into the details. But they're very strong signals. I don't use them for the primary reason to get into the trade, but as an accompaniment to the main reason. So the main reason, again, is we came into the bullish order block, which every single time we've come into the order block, VIX has rallied. Conversely, every single time we've come into the order block, the market has gone down. That's why I was concerned about the market going much higher, because the VIX was coming down here. So I did enter, luckily, on Thursday at 41.60. I placed my I position size correctly. I placed my emergency stop 2 ATRs below as always. My end of bar stop was a close below the low of the order block at $40 exactly. I placed my 1.5 ATR trailing stop level above my entry price. And you can see Friday, huge up on VIX. I hit 3 profit targets, almost hit 4. But so I took 30% of this trade off into this big strength bar. In addition to that, I got to trailing stop level in one day, which is pretty hard to do, but we did it. And so now going forward, if I have a close below previous bar's low, I'm going to get out of half. And so the remaining shares that I have on VIX currently up 6.52%, which was really good because that was one day. And again, the strategy was a bullish order block. Okay, next trade, IBB. NASDAQ Biotechnologies. I entered this trade on Friday. Why did I enter this trade? Well, in this example, you have a red box instead of a green box. This is also an order block, but this is a bearish order block. So a bearish order block is your highest up bar close before we have market structure change. We change market structure here on this day, on the 10th, because we took out this previous swing low. So we were in an uptrend. This changed it to a downtrend. So do I get short here? No, I don't. I don't short as soon as it changes structure to the downside from the upside. I wait for a check back into the order block. So big picture, if you go from bearish to bullish, so if you go from a bearish structure to a bullish structure, you generally want to buy that first dip. If you go from a bullish structure to a bearish structure, you generally want to short that first rally or that first rip. And so that's exactly what I did on Friday. The order block, again, is the range of the high and low of the biggest up bar before market structure change. And you can see many things happen on Friday. One, we rejected the order block, meaning we got into the order block and then came back down. We rejected the low of the order block. But in addition to that, we also rejected the 200-day moving average. In addition to that, we had a bearish V1. This is the opposite of what I showed you on VIX. We have a high, we took out the high, and then we closed below the close of the previous bar. That's a bearish V1. So How am I going to manage this trade going forward? Well, obviously I position size correctly. I place my emergency stop, as always, 2 ATRs above. Here's my 1.5 trailing stop level. So if I get down there, then I'll go into trailing stop mode. And for this particular trade, my end of bar stop, a good place for this end of bar stop would simply be a close above this 200, because on Friday we tried to get above it. There were no more buyers there, and it reversed down. So I want to keep the stop as tight as I can, so I have a good risk to reward ratio. So going forward, if we close above this 200, that will be my end of bar stop. And of course, I've got the 2 ATR emergency stop above. Now, if it moves down, I'm going to start taking partial profits. How am I going to do that? Well, here's my closing price, 138.91. What's the 0.45? 103. I take 138.91 minus 103. That's my first profit target. Then I do it again and I do it again. So I will have 3 limit orders in the system. If it goes down, if they're hit, I'll take it off, reduces my position size. So I'm exactly even on this particular trade. And so, yeah, these are the open trades. Again, NVIDIA, the remaining shares I have up 12.48%. VIX, the remaining shares I have up 6.52%. And IBB is completely break even. Okay, let's go to, excuse me, let's go to IWM. This I closed this trade out on Friday. Huge down bar, but you know, this is a very good example, everyone, of why I prefer to take partial profits, and I have rules like the trailing stop rule that get me out of half, and you'll see why in this particular trade how important that was. So let's go back to when I entered the trade. When did I enter the trade? I entered the trade on the 13th of January. Why? Intraday deep dip, intraday rejection of the 200 plus a V1. So that's a deep dip. I position size correctly. My emergency stop, 2 ATRs below. My end of bar stop, a close below the 200. Placed my 1.5 trailing stop level. Took profits, took more profits, got into trailing stop mode. Then here on the 27th was the first close below a previous bar's low after reaching trailing stop level. I took off half of the position for a gain of 4.3%. And then going forward, we, moved up here. I took some profits here, hit a profit target there, hit a profit target there, hit a profit target there. And then on Friday, I had to exit the trade. Why? Well, because it closed below the 200. That's my end of day stop. I had to get out. Now, on the remaining shares, yes, I had a gain of 0.19%, but does that mean I made 0.19% on the trade? No, of course not. I made way more than that, because taking the partial profits, having the rules in my process, here I took off half, so 435. So if you had just entered this trade with the 200 and got out with a close below the 200, you would have made 0.19%. But using the partial profits, using the trailing stop methodology that I use, you can see that's a really nice trade, even though, yes, it was a huge day down on Friday, but taking those partial profits up here really added up. So I closed out this trade on IWN for a small gain of 0.19%. But again, it shows you why taking the partial profits and having these trailing stop rules really make a big difference. And this is what I do. I use this. I use these every day. I teach these in my private lessons, and get to know these. This is important, and this is a perfect example of why. Okay, so that is IWM on the daily. Close that out. Now let's go to the weekly bars. I like to trade daily bars and weekly bars. Well, you see a green box down there. What does that mean? Some kind of bullish order block. And if we go all the way back here to the 20th of October, here's your lowest bar close. Here we change market structure to the upside. So therefore, if you have a pullback to the green, that's generally the place to buy. Didn't quite get there, but it got close and then rallied again. And then here, I've been in this trade for what, a month and a half. January 17th, I got into the trade. Why? Well, first and foremost, we rejected the order block, and we also had a V1. Bar 1, bar 2. Bar 2 goes below, bar 1's low, closed above, bar 1's close. And technically, we also rejected the negative third ATR channel. So I got in at 87.20. I placed my emergency stop 2 ATRs below, as always. The end of bar stop on this one's a little bit different, but it's halfway of the V1 bar right here. I drew that a little off. Yeah, right about there. So a very good risk to reward ratio. When you have a V1, if you close below halfway of the V1 bar, that's generally not a good sign. And so I have a very tight initial stop on this, but so far it's worked out. You can see here's trailing stop level up here. I have not hit that yet, but all in all, the trade, these are bonds, so they don't move a whole lot percentage wise, but it was a good setup. That's why I took it. And so on TLT, currently this trade is up 2.78%. And then last but not least is DDM. This is double leverage Dow. And I shorted this trade. And why did I short this trade? Well, I shorted this trade. You can see the order block up here. Here is your highest up bar close before market structure change. Remember, if you go from a bullish structure to a bearish structure, I'm looking to short on any check back or rejection into the bearish order block, and this happened here. I got long on the 31st of January. Why? Because of the rejection of the bottom of the order block. I got short at 103.70. Position size correctly, placed my emergency stop 2 ATRs above. Where's my end of bar stop? Just the close over the high of the order block at 107.53. Placed my trailing stop level 1.5 ATRs above. And you can see for a couple weeks we really didn't do anything. This week we were down 5.03%, and I did hit 2 profit targets on this bar. I'm not to trailing stop level yet, but still really nice trade, really good example of being in a bullish structure, changing to a bearish structure, and re-shorting while that bearish structure is still in place on a rally. And so this particular trade so far on the weekly is up 5.19%. So all in all, a really good week. I think a good example, I mean, most of the trades here that I showed you were order blocks or deep dip buys. But I do trade 7 different approaches, 7 different strategies. I teach a one-on-one course. I'd love to have you as a student. It's a 15-hour course. I do 5 sessions one-on-one with my student. Each session is 3 hours. So it's a serious course, but I'll teach you all 7 of the different strategies that I use. I teach you step by step. We do all sorts of simulations. And so when you're done with that course, you're going to know how to trade like I trade. And so, like I said, I'd love to have you as a student. I've taught people from all over the world, all the way from absolute beginners all the way to the hedge fund levels. So if you're interested, just email me. My email is in the link of the description. So, okay, that's it. Those are the trades, the ones I exited, and the remaining current shares, current trades that I have as well. So before we get to the potential trades I'm looking for next week, let's pop over and take a quick look for trading psychology. This is from Linda Raschke, probably the most famous female trader. I've met her. I've been to some of her classes. She is a market wizard. She's in the Market Wizard series, and she's phenomenal. And I have learned a lot from how she trades. But from a trading psychology standpoint, let's see what she has to say. The successful trader does not base moves on what supposedly will happen, but reacts instead to what does happen. And really, there are 2 types of traders in this world. There are the profitable traders that wait for exactly the signal to happen, the rejection of the 200 or the rejection of the order block or whatever. And then the other traders are the ones that say, well, I think it's going to get back above, so I'll just buy now. Or, I think it's not really going to test the order block and it's going to go up right now. Listen, I've traded for almost 30 years now. You are going to have a more healthy and happy trading experience if you just sit on your hands and you just wait for your signals to appear, not to predict that they're going to happen. Like if you're a breakout trader, oh, I think it's going to break out here, so I'm just going to buy it now before it breaks out. Well, then it never breaks out. Like we've all been there, right? I always, every week in this podcast, try to just tell you, follow your rules. Don't deviate. Don't anticipate. Don't theorize. Just let the market show you and tell you by price action that what you thought was going to happen happened. Because if it doesn't happen, it didn't happen, and your strategy has not fulfilled its rules. So the successful trader does not base moves on what will supposedly happen, but reacts instead to what happens. Don't forecast it. Just wait for it to happen, and you're going to be a better trader. Again, it comes back to following your rules, whatever it takes. And if you're in a trade and you don't have rules to follow, that's an uncomfortable situation because you're always like, should I don't know. Well, it's no fun, man. Go for a walk or do something. Let the trade work itself out. Okay, I lost money on this trade. That's fine. And just take comfort and solace in the fact that you followed your rules, whether you make money or not. So thank you, Linda Raschke. Appreciate that. I hope that was helpful for everyone. And now let's take a look at the potential trades for next week, shall we? Okay, so here on the daily or the potential trades that I'm looking for, I mention this each week, but yes, here I have 7 potential trades. Theoretically, they could all get there in the same day. And does that mean I would take all 7? No. I have a rule. I only take 1 trade per day. Even if 7 of these trigger, I'm only going to take the best one. How do I decide what's the best one? Well, which one has the best risk to reward ratio? Which one has the most signals, the most confluences? Which one looks best on multiple time frames? If these all trigger on the daily, I'm going to switch and look at all of them on the weekly to see if I can see some corresponding signals on the weekly charts as well. It just improves your chances. Which one has the best relative strength compared to the rest of the market? Or if I'm shorting, which one has the worst relative strength compared to the market? These are, the devil's in the details in trading, and, this is what I do. I basically give them a score. Okay, Amazon had 1 point. Caterpillar had 2. Google had 3. INDA India had 4. Which one am I going to take? Well, I'm going to take India for sure, right? And so this is what I use. This is what I teach my students as well. It really makes a difference. Just one signal. Do I take just one signal? Not usually, right? I want to have multiple signals. I want to know, really, what does the signal mean? The signal means a group of buyers came in and did something. So do I want to buy something that had 1 group of buyer or 4 groups of buyer? Well, my chances of having a profitable trade go up dramatically with the more buyers that I have, right? So again, this is what I teach in my one-on-one course. It's very important. It really makes a difference. So if you are interested in becoming a student of mine, my email is in the link in the description, and love to talk to you. And just by the way, if you do call, I'd like to have a free Skype call with an initial student or with prospective student. It's not a sales call, I promise you. I'm just trying to learn more about you, your trading, your challenges, your goals, and it's a good time for you to ask me any questions about the course. But I just want to reiterate, it is not a sales call. So let's start with Amazon. Well, Amazon really got hammered on Friday, and we've changed structure from bullish to bearish, so I'd be looking to short any significant rallies in Amazon. But right now on Amazon, we are getting to some interesting levels. Let me take your attention to this line here. What is this line? Well, I'm just connecting this swing low to this swing low and drawing it out into space. These channels tend to, markets tend to react to these channels. And so if you draw the bottom here to the bottom here and draw it out, it shows that, not for sure, obviously, but likely you may have some symmetrical buyers coming in here. Well, look at the RSI. It's 3463. So back to deep dip buys, we're getting close to a 30 RSI. The 30 RSI is a legitimate deep dip buy. An under 30, over 30, or intraday rejection of the 30 RSI. That is a legitimate entry. But the confluence would be, we have the channel line is going to dovetail nicely, depending how quickly it gets down there. It's going to dovetail nicely with that 30 RSI. So if we did, like, the best potential on Amazon would be that we went below the channel line during the day, closed back above it. In addition to that, from a deep dip buy perspective, we go under the 30 RSI, over the 30 RSI. That would be a legitimate deep dip buy trade with the bonus, and the bonus would be the trend lines. And I forgot to mention too, if you like online courses, I keep talking about deep dip buy. I have a deep dip buy course available at udemy.com. It's 9.5 hours of video, and I go through exactly how to trade the deep dip buy, and the links in the description of this video if you're interested in that course. But that's what I'm looking for on Amazon. I mean, Amazon really has got hammered. I would imagine somewhere we'd have some buyers. What did I just say? I imagine. Okay, really, that's not good, right? And it's just human nature. But I know enough about trading to realize that, yes, I just said that, but it may happen, it may not happen. But just from experience, I'm saying it may happen, but it may not. But I'm not going to get in Amazon unless I go under 30, over 30. But isn't that funny how even I have to catch myself with that? What was that? That was prediction, right? We can't predict, but that's just experience, but I could be totally wrong. But if that happens, again, waiting for the trade to confirm and actually show me instead of thinking it's going to happen, I'm not going to get in a trade unless we get an under 30, over 30, and or a rejection of this channel line here. So that's what I'm looking for, somewhere in this area, probably in the 210 area, something like that. But it's hard for me to say because I don't know how many days it's going to take to get there. It may never get there. It may just head back up. And if it heads back up, then I'll be looking to short, because there's your order block. That's your highest up bar close before market structure change, right? So that's what I'm looking for on Amazon, either a deep dip by under 30, over 30, rejection of that channel line, and ideally both of them. All right, let's go to Caterpillar. All right, Caterpillar has just gone a straight down, but here's your green box. What does that mean? That's an order block, and this order block started all the way back here on 9/11. On September 11th was your lowest, or no, sorry, 9/6. Your lowest bar close before you market structure changed to the upside. Therefore, if we get back into the bullish order block, that's an interesting place for me to potentially buy. You can see we did not quite get there on Friday, but going forward next week, look here, from a deep dip buy perspective, we're at 29.03. If it closes above 30 RSI on Monday, for example, would I get in the trade? I don't know. Honestly, I don't know. Probably not, because of this big down bar. But what I'd really like to happen is if we go lower, reject the bottom of that order block, then yes, I would take the trade. But ideally, if it moves down a little for 2 or 3 days, kind of dances around, and then rejects the bottom of the or the top of the order block, and also rejects the 30 RSI, then that's a good trade. So I'll just have to see what happens. But I think we're coming into a buyable area. I think, I don't know, but I still need to wait for the price action to tell me that something's rejected. And at this point, it would be the first thing I'm looking for would be a rejection at the top of that order block at about 335. So it may it would have to still go down about $6 or more. So that's what I'm looking for. Caterpillar deep dip buy. Google, GOOGL. Well, dang. With this order block up here, it did make it above, but now it's really come back down. So this one is just a straight deep dip buy. First level that I'm looking for is the 200-day moving average, the black line here. Right now, we're at 37 RSI. If we come down to this 200-day moving average, very likely the RSI will be 30 RSI. In the deep dip buys, the best combination that you can have is a rejection of the 200-day moving average or the 250 or the 300 at the same time you reject the 30 RSI. That is a AAA rated setup, especially on a big time stock like Google. So that's what I'm looking for. If we go lower and reject that 200-day moving average at the same time we reject the 30 RSI, that's a good setup. Does it mean 100% it's going to work? Absolutely not. But I can say with a lot of certainty that if that happens, your odds are going to go way up that that's at least a short-term tradable bottom. So that's what I'm looking for on Google, rejection of this 200-day moving average. Cherry on top would be a rejection of the 30 RSI. INDA. Okay, INDA, as bad as this looks, everyone, is one of my favorite, from a big picture standpoint, is one of my favorite setups. You might say that looks horrible, and it does. I'll give you that. But from a MACD perspective, from a divergent perspective, and again, I teach this in my one-on-one course, but let's take a look at the MACD bars here. Here are the red bars. Here we have the lows with deep red bars. Then we rally, we go to green bars. Now, look here. Are we lower here than we were here and here? We certainly are. But is the MACD bar as deep here as it is over here? It is certainly not. That is what's called a double bottom with a bullish divergence. All that means from a MACD perspective is that even though we're lower and lower and lower, it's not showing up in the MACD reading. So really what that means is the momentum is waning. Even though we're going down, the momentum is not as strong here as it was here. So that is called a double bottom with a bullish MACD divergence. That is showing you, big picture, that you're probably getting near a short-term low. We can look at some other things. Look at the low here. Look at the reading of the RSI. Very deep here. We are lower here than here, but the RSI is not even anywhere close to this. That is a RSI divergence. Look at the ATR channels. This is the -6. This probably puts it like the -11. Here, we're lower here, we're only to the -4. So we have a trifecta of divergences. MACD divergence, RSI divergence, ATR divergence. Does that mean just go ahead and buy? No, it does not. What it means is that the stage is really set for a bottom to be in. But again, going back to what Linda Raschke said, we need to wait for confirmation. There is no signal to buy here yet. What would be a signal? Well, we're at a 3510 RSI, so a deep dip buy under 30 over 30 with this overlaid on top of it would be fantastic. So really, of all the charts that I'm looking at, technically, INDA, the Indian stock market, makes the most sense to me. But I can't anticipate that this is the bottom. I need one of the signals to show me that it's a bottom. Another potential entry might be if we gap up on Monday. That would make this a abandoned baby, right? What are abandoned babies? Well, go to my YouTube channel. I have a video in there about an abandoned baby and island reversals. Very strong signals. Basically, an abandoned baby is when you gap down, and then next day you immediately gap up, showing that we went from very bearish sentiment to very bullish sentiment very quickly. So really, for me on INDA, if we go lower, reject the 30 RSI or reject this channel. Look, here's the low, draw those out into space. What do you got? Well, there's your theoretical channel right there. That might be a place. If it rejects the channel, I'd very likely take that trade. If it rejects the 30 RSI, I would very likely take that trade. Or if it gaps up on Monday and creates the bullish abandoned baby, then I would potentially take the trade there. But from a MACD perspective, if Alexander Elder saw this chart, um, he would be watching this very closely, and so am I. And just look at this. Look at this. Look at this move, everybody. I mean, all INDA did was go up and up and up and up and up and up and up. And look at that. Massively down. But look at the big picture when you zoom out a little bit. Look at the deep red back B bars here and then nothing here. So that is what I'm looking for. Just waiting for rejection out of the channel, rejection of the 30 RSI, or a bullish band of baby. Let's go to PayPal. PYPL. Okay, so look, this was a legitimate trade on Friday, but I did not take it. Why? It's a deep dip buy. We bounced at the 200-day moving average, right? It bounced, but that's all it did. I don't see any confluences here. Had it closed back above the negative third ATR channel, that may have got me involved, but it did not. We're at a 32.25 RSI. So pretty close to the confluence of a rejection of the 200 and the 30 RSI. Had it rejected the 30 RSI as well, I would have taken the trade, but it did not. So what I'm looking for on PayPal are two things. If it may just go up from here and I miss the trade, but I want to see the 30 RSI tested. I want it to go under 30 and back over 30. And so I would be looking here at the 250-day moving average or the 300-day moving average as well. But what I really want to see is under 30, over 30. Just this bounce at the 200 was not enough, and it didn't close above the negative third ATR channel. So again, on PayPal, if I decide to enter PayPal, it better be good, and an under 30, over 30 with a rejection of the 250 or a rejection of the 300 would be good, but just the 200, not enough. I want to see that 30 washed out. XLF, which is the financials. Well, the financials really got beat up here, and we have changed market structure on XLF. We broke the trend line. We took out the swing low. So what I'm looking for on XLF is some kind of short. Now that we've changed structure to the downside, I want to wait for a check back, a counter rally, a counter up move into the down, bigger term market structure down. So essentially, if we were to rally, come back, reject the bottom of the order block at 51.75 or the top of the order block at 52.21, that's where I would be looking to get short. And it may just continue down. I'm going to miss it. But because we changed market structure from up to down, now I want to look to short any rallies. And inside this bullish order block would be the area. Last but not least, XLV. XLV almost triggered. You can see it's a red box, which means that that is a bearish order block. Our highest up bar close here on the 5th. We broke structure to the downside. I'm waiting for a rejection of the bottom of the order block there at 147.56 or a rejection of the 200. And you might look and go, well, Greg, it already did reject. It did. You're right. It did reject. Remember how I got short IBB? IBB had a better setup than this, but I may also look for another. Sorry, I got a call there. I may look for another entry into XLF, most likely if it rejects the 200, because I already have the IBB short. So if it rejects the 200-day moving average, which is inside the bearish order block, that is where I would look. And it would give me a good risk to reward ratio too, because as long as it's under the 200, I'm staying in short. But if it ever closes above the 200, then I'm simply out of the trade. Make sense? So those are the dailies. Let's head over to the weeklies. Weekly bars close on Friday. And let's go to Advanced Micro Devices, AMD. All right, well, AMD has had a heck of a time. Let's get some perspective on this. All right, AMD has a really nice order block on the weekly, starting at 102.05, and the low is 92. So that's what I'm looking for. And the top of the order block dovetails really nicely with the negative third ATR channel. So basically, for me to get long AMD, it would have to come down, bounce off the top of that order block, which would also dovetail very likely with the 30 RSI. So a lot of confluences in this area, in this range. If it keeps going down, doesn't reject the top of the order block, but rejects the 300-day moving average, that would be a really sweet. I don't know if it's going to get there, but if it does, that would be a really sweet location because you have a bullish order block and you have a deep dip buy at the 300. So, I think if people are patient enough and if it does go all the way down there, that was a really good long-term look, long-term entry with a good risk to reward ratio, because if it rejects the 300, then the next week it just closes below, I'm just out. Then what do? Well, maybe the next week it closes back up and I can try again. So, AMD has really gotten hammered, really, but it's in it's some interesting areas, getting close to a low 30 RSI, getting close to major moving averages, getting close to an order block. But keep in mind, the headlines are not going to be good. It's not going to feel warm and fuzzy to buy down here. But if we go back in the past, headlines probably weren't so great here either. Headlines probably weren't great either. I mean, look, we got to the 300 here. We rejected the 250 there. Was that a good place to buy? For sure. But if you go back, the news wasn't so good and sweet and warm and fuzzy, just like it's not now. So don't let that interfere. Look for your signals. Look for the market to tell you, okay, we don't like this level. And so the levels I'm looking for, the top of the order block, 102. So if we go down, reject the order block, close above, that would be a signal. Alternatively, rejection of the 300 SMA, weekly SMA here would be another, but this is the area. And then Merck. Okay, so I talked last week about Merck, about getting into the order block. Well, I didn't take it last week because it did not reject the order block. You can see it got into the order block, but it didn't reject it. And then it gapped down lower, and now it's hugely rejected the order block. Isn't that interesting? That once we get down into the green, that's where we bounce. And the green goes all the way back to the order block here, back in 22. But look at that. As soon as it got there, that's where it bounced. So did I buy this on Friday? I did not. Why? Because the risk to reward is not good at this point. It was such a big up move out of that bullish order block that where's my stop? Here, 79, it's a $10 stop, too much. So we had a V1 here. 2 weeks ago was bar 1, last week bar 2. Bar 2 goes under bar 1, closes back above. It's a good signal. So how do I get into this trade? Well, it's a little tough now because the risk to reward ratio is not good. But when you have a big up bar like this, you see how I have the green bar in the middle? That's halfway from the bottom to the top of that green bar. If we come back down and backfill a little bit and reject that halfway of that bar at 84.90, then I may consider getting in there, because we've also rejected the order block, but I just want a little bit of a backfill. I want a little bit better of a price. So next week, if we come back down, reject 84.90, then I may enter the trade there. Last but not least, XLU. Okay, you have a red box here. What does that mean? That's your order block. Here's your highest up bar close. Here's where you change structure. If I change structure to the downside, I want to look to short the rallies, but I would not start shorting unless we reject the bottom of the order block there at about $81. So next week, if we come up, go above 81 and then close back below, that is where my short would be. If it closes in the order block, I'm not going to do anything unless it keeps going up, rejects the top of the order block. That might be something. Or if I have a V1 or a V2, bearish V1 or a V2 in the order block. All right, so those are your weeklies. Let's quickly, before we go, let's take a look at the indexes. Let's take a look at the Qs. Let's take a look at the SPY. and see if that might be helpful for you. I hope it is. And by the way, if anything I've talked about today is helpful, I really would appreciate if you could hit the thumbs up button. But let's kind of take a look at the cues and see what happened. Something happened. Well, from a technical standpoint, look, here was our previous high over here on the 16th. What was that? Just Tuesday and Wednesday? You see how we tested above the previous high and rejected? So we rejected this previous high. We certainly did, and that was it. Now, the bar that we had on Friday, it's brutal, man. It was brutal. I mean, look at the channel. This swing low to that swing low. It sliced right through it like butter. Not a good thing. If we take a look at some other potential channels, here's this low, here's this low. You go those out in space. We may find some support here next week, maybe about 521. We're at 526. So when you have these big bars like this, we're down 11. It's not uncommon. God, Greg, speak English. I was in Colombia for 3 months. For another half of what happened. So, maybe another 5 or 6 points to happen again on Monday. I wouldn't be surprised at all. But if that happens, it will bring us right here into this trend line, right into this channel. So I don't know if it will hold. It's just an idea. The only thing on cues that makes me, that I would feel really comfortable about buying would be this order block, right? Here's your high and the low of the order block before we change market structure to the upside. But that's all the way down at 506. That's another 20 points down. It could happen, everyone. It really could happen. But if it does get down to the high of that order block, that would certainly be interesting. But prepare yourself that we may go down half of what we lost on Friday. So we may go down another 5 or 6% and possibly get into this lower channel here. And then let's look at the SPY as well. Very similar. Again, we tried all-time highs, got above them, failed. We got right through this channel line. We sliced right through it. So where's the next channel line? Down here. Of course, here's an order block here at 582 as well. So it's not looking real great, everyone. Really, it's not looking real great on technically on the indexes. So please be careful, everyone. Wait for your signals. Don't take them unless what you want to, exactly what you want to happen happens. If I can help you with your trading, like I said, I teach one-on-one lessons. Love to have you as a student. Just send me an email. If you would like to take my online course at udemy.com on the deep dip buy, the link's in the description as well. If you have any comments or questions about anything I said here, write them in the comment section. I'll do my best to get back to them. I always like to leave off with, have a great rest of your weekend. Try to go out and do something nice for someone today. If we all did one nice thing for another person around the world, imagine the world would be a better place. If you could also find it in your heart to do something nice for an animal one time a day or whenever you have the opportunity. They appreciate acts of kindness just like we do. And so anyway, thanks for coming, everyone. I hope you found it helpful. If you haven't subscribed, please subscribe. If you could leave a thumbs up, I'd appreciate that as well. But God willing, I will see you next week. Thanks so much, but please be careful next week, okay? All right, we'll talk to y'all live. Bye-bye.
Required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.